안녕하세요 여러분 반갑습니다. Good evening everyone. Bonsoir tout le monde. I'm very pleased to see you here, though virtually, at this open seminar, The Long Shadow of COVID, Bank, Zombies and Growth. We are in unprecedented difficult time of the COVID-19 pandemic. Today we have Professor Hyunju Lee from Ryerson University. She may guide us to understand the pending difficulties and further to find the ways of moving forward. COVID-19 has created enormous hardship for us. It denies our raison d'etre by disrupting communications between the social elements. It also places our survival in jeopardy by disrupting daily economic activities, thus distorting normal function of the economy. Fortunately, the high tech of IT and AI allow us to explore the path to the future, as does the famous Welland Canal to connect the Great Lakes for the prosperity of the surrounding area, while overcoming barrier of the Niagara Falls. We are in Toronto, near to Niagara Falls, which is considered another Silicon Valley, with the so-called another Wall Street, Bay Street, supported by the global ethnic hub, connecting us to the world through its global network. In a sense, Toronto seems to be at the forefront of fighting against the COVID-19 pandemic. Overcoming the COVID-19 economic crisis is not easy job. However, we have accumulated wisdom and strength to manage the economic crisis in the past. I'm sure we can do that again. Today, we have Professor Lee here. Her expertise may offer a better understanding of the basic nature of the current difficulties, probably focused on financial sectors, and lead us to look forward to the ways of their conquest. I hope you will enjoy the presentation and following discussions this evening. Thank you, Professor Lee. 감사합니다, 여러분. Thank you very much. Merci beaucoup.
So my name is Hyunju Lee from Ryerson University, and today I'm going to talk about the long shadow of COVID, banks, zombies, and growth. And today I'm going to speak in English, but if you have any questions, either in Korean or English, you can either write on the chat or like a mute if you have any clarification questions. And I'm targeting 30 minutes, and after this, we're going to discuss further. And let me start with this graph. So these days, I'm spending a lot of time thinking what the world and especially the economy would be like after COVID. And today is a particularly good day. Well, just a couple hours ago, U.S. has released its new GDP figures, which is the gross output figures of the economy. Well, U.S. is one of the countries with the highest vaccination rates among the advanced countries. So I think this is a sneak peek of what's going to happen after the vaccination rolls out and the economy reopens. Well, over here you see this red line that is the pre-pandemic peak. And one thing you see is that the economy is rebounding strong. So over here, the economy, U.S. economy, is almost back to its pre-pandemic peak. Well, that gives us some hope. Maybe we're going to be going back to the pre-pandemic level very soon. And especially compared to the financial crisis, this is a record pace of recovery. Well, so are we going to go back to the normal soon? And especially the economy, will it get back to the pre-pandemic level? Well, in order to answer that question, let me use the data and go back to the financial crisis and learn from data. What was the recovery like after the financial crisis? Well, since 1990, the economy has been growing so steadily. You can see this blue line. The economy has been growing along this line, well, until the financial crisis hit in 2008. After the financial crisis hit, one thing you notice is that the economy never really grew back to this blue line. What does that mean? Well, unfortunately, after the financial crisis, we have settled to a new trend, a lower level of economic growth since financial crisis. Well, the natural question arises is then after we come out of this COVID pandemic, are we going to settle to another lower level of economic growth? Well, one thing that has led this lower level of growth was financial crisis. Then, are we expecting another financial crisis due to this COVID recession? Is the financial system stable enough so that we don't have any financial crisis? Unfortunately, there are some red flags. Well, the strong rebound was, in a sense, debt-fueled, meaning that during the pandemic, a lot of sectors in the economy has issued a lot of debt, meaning that they have borrowed a lot. Well, you see here the red financial sector and the general government, the blue line, and then non-financial sectors. So this is usually a red flag for financial crisis. So let me combine all these questions. What's gonna economy look like after COVID? And are we expecting another financial crisis? So to answer those questions, let me narrow it down to this: banks, zombies, and growth. And these are the messages that I want you to take away after this presentation. Well, about the financial stability, we do have safer banking system because of tighter banking regulations. But after COVID, I want you to be aware of zombie firms that are lurking in the economy with lower productivity. And these two might seem a little bit distant, but let me tell you a story that could combine these items. So after the financial crisis, because we don't want to have another financial crisis, there are new, tighter banking regulations. But there was a cost. Shadow banks has arisen. Shadow banks are not banks, but acting like banks. Well, they are lending to firms, and they could be a little bit more risky. And at the same time, banks are lending to less productive firms, which gives a rise to zombie firms. Zombie firms are not so productive, but not dying out, just like zombies. Well, so I want to weave a story of how COVID actually could deepen this kind of trend that has been going on after the financial crisis. So what are some implications of these smaller items? Well, shadow banks could lead to more unstable financial system, and bank credit going to less productive firms, meaning that we could expect even lower growth rate. And because zombie firms are hanging around, not dying out, so we may see less business dynamism. So in the following presentation, let me go through one by one of these items. And if there is any question in the middle, please do ask on the chat room. I'm monitoring on this side over here. All right, so if there's no question, let me go to the banks. What has changed after the 2008 financial crisis? Well, one thing is that the banks are under tighter regulations. It is called Basel III. And what does it mean by being under tighter regulations? Well, they need to keep something called a higher level of minimum capital ratio. It may seem a little bit like a jargon, but it basically means that in order to invest, say, $100, it used to be the case that banks could just put, say, $10 of their money and then borrow the rest $90. But then, what's the problem? Well, banks could be a little bit reckless because it's not their money. So what the new regulation says is that bankers now need to put more of their money so that they're a little bit less reckless in terms of doing risky investment. Well, but then banks could be safer. But is that where are all this risky investment going? Well, in order to answer that question, what is the impact of this new regulation? Well, I have this new exciting data from Korea. So I have a data set that for any firm, large firm that you can imagine, I know what that firm, from whom that firm is borrowing. So imagine, I don't know, Samsung, Kia, Hyundai, and I know exactly how much that firm is borrowing from which bank or which shadow bank. And this is a graph that is showing the aggregate trend of what's going on in the financial market as a result of this new financial regulation. You see two lines over here. Well, the dotted blue line is the aggregate amount of lending by regulated banks. Well, how much of all these firms borrow from regular banks? Well, that amount has been declining over time. Well, banks need to put more of their own money to do the risky business, which is lending to firms, and they cannot raise this capital so sudden. So what they do, they cut out this lending to the firms. Then firms, they need to invest and they need to do the business. Where do they go? They could go to the shadow lenders, not the banks, not so under strict regulation, but they can still lend to firms. So you can see this red line, the shadow lenders amount has been rising steadily after the new financial regulation. And maybe you're wondering, well, this is just an aggregate trend. How do we know whether this is a result of this new regulation? Well, believe it or not, like I've spent many sleepless nights to produce this graph. So this is from my original research, where it shows that most of the decline in this banking regulate or the bank lendings are actually due to this new regulation. So you see this new dotted line, the one says model. So this is the model prediction showing that most of the decline in bank lending is actually due to this new regulation in the banking sector. And most of the increase in the shadow lending or the shadow banking lending is also coming from this new regulation. So that was a general trend of what's going on in the banking sector, that the banking sector is shrinking, but shadow banks are on the rise. So let's go dig a little bit deeper about shadow banks. So I've already discussed a little bit. So shadow banks are the financial institutions acting just like banks, so sometimes called non-banks. And the kind of benefit of shadow banks is that they're less regulated than banks. And they are composed of like many different financial institutions like insurance companies, wealth management, investment banks. And this is what it looks like in Korea. So this is using this new data set that I have acquired for my research. And you can see that insurance companies are a big chunk of the financial or the shadow lending sector. And the wealth managements are also rising, investment companies, mutual finance, and all other different sector or financial firms are acting as shadow banks. And one of the events that was showing what a shadow bank could do is the Bill Hwang and Archegos. So recently, if you're following the financial news, there is this one family office that has engaged in very risky investment, and the investment turned out to be a bust. But then what happened is that to this one family office, these major banks have lended so much, to the extent that after this one family office has gone bust, all these banks have losses of accruing around $10 billion. So Archegos, or the Bill Hwang office, is one of the shadow lending business. So this shows that how actual risk could be hidden in the financial system, and especially in the shadow banking sector. So the rise of shadow banking sector could actually impose a larger financial instability, and hopefully not, but a more chance of financial crisis in the future. And furthermore, what do these shadow banks do? Well, I have this new colorful graphs over here. And one message I want you to have in terms of who or which firms are borrowing from shadow banks. Well, more productive but smaller firms are borrowing from shadow bank. And this graph can tell you that. So first, you see this many colorful dots. One dot is firms of size. On the x-axis is size. On the dots on the right means that it's larger firms. Dots on the upper side means it's a productive firm. So a darker dot means that for $100, the firms are mostly borrowing from shadow banks. If you see a lighter dot, it means that they're mostly borrowing from banks. So what you see over here, let's focus on these two quadrants. On the left upper side, you see more productive but smaller firms. And look at the color of these ones. It's darker, meaning that smaller but more productive firms. You can think of this IT firms like, I don't know, like Kakao and Naver. Like those firms are relatively smaller but very productive. So these firms actually tend to borrow from shadow banks. And on the right bottom corner, you see lighter dots, meaning that these large but not so productive firms, well, one of the examples was actually the shipbuilders in Korea. They are big, but they were not so productive during this time, but they are borrowing mostly from banks. Well, then what's the implication for growth? These small but very productive firms are cut off from bank lending. And these larger firms are staying with this relatively cheaper and more efficient bank loans. What does it mean for growth? Well, this leads us to the final sector, the zombies. So, well, before talking about growth, well, the Korean firms are also being zombies. Like the film industry has been very successful in zombies, and firms are also becoming zombies these days. So what are the zombie firms? It was first coined by the Japan's Lost Decade. So if you're more interested, there is a paper by Caballero and al. That you can look at. So generally, these zombie firms cannot cover their interest payments from their profits. They're so unprofitable, they cannot even pay for their interest payments. and for a long time. So zombie firms tend to be less productive than non-zombie firms. And the thing is, zombie firms are on the rise globally. So this is a paper by Banerjee and Hoffman. And let's look at this large figure. You see two lines over here. And let's look at this blue line. This is the share of zombie firms on the left axis. So for the OECD countries, which is more advanced countries, and before 1990, only like 5% of the firms were zombie firms. But at the end of this period, 2017, almost 16% of the firms are zombies. And you see this right-hand side, probability of remaining a zombie. This means this year, 2021, if you are a zombie firm, what's the probability the next year, 2022, this firm is still a zombie? Well, the probability was kind of low at the beginning, but in 2017, almost 90% of the zombie firms remain as a zombie in the next year. And one worrying figure is that in Canada, a lot of firms are zombies, and that fraction has been increasing. More than 30% of the firms in Canada seem to be a zombie firm. And what gives a rise to these zombie firms? One of the things that gives a rise is low interest rates. Well, zombie firms are paying, they cannot cover the interest payments from their profits, but they're not dying out, meaning that they're not filing for bankruptcies and they're hanging on. Well, one of the things that could help this to happen is low interest rate, because it's cheap to borrow from the market, so they just hang on without going bankrupt. And another thing is banks, keeping them alive. So we've seen before that banks are lending more to these large but unproductive firms. So those two are related. Then, what does the COVID would do, or the policies related to the COVID would do to the zombie firms? One thing that we observe is that the interest rates are record low after COVID. Well, I have these three graphs, Korea, Canada, and then US. Since 2016, 2017, after 10 years after the financial crisis, the interest rate has been going up, but as soon as the COVID hits, the interest rate is almost to zero. This could help the zombie firms to thrive. Okay. Oh, and there is actually a question. The percentage of zombie firms are issuer of publicly traded firms? Yes. So for this paper, it is for the publicly traded firms. And yeah, maybe I have missed it. Like for my graphs too, for Korea, these are the publicly traded firms too. Okay. And there's another question. Are zombie firms typically in industries without close substitutes? That is a good question. Well, actually, maybe the next one will explain some of this question, because, well, zombie firms are related to growth, and let's look at the historic event of Japan. So zombie firms are coined from Japan's lost decade. What happened then? Well, there are a lot of zombifications going on, and especially in the construction sector. What happened in Japan in 1990s was that there was an incredible boom in the apartments and the real estate market, and then real estate bubble was collapsing with the stock markets. So what happened is that zombification has been going on, especially in sectors like construction. So over here, you see two graphs. On the left-hand side, on the x-axis, is how much more firms turned into zombies. So for example, manufacturing saw less of zombification, but construction is one of the sectors that has seen more of the zombies. So for these firms, they actually need to die out when they're not so profitable, but they're not dying out as much. So over here on the y-axis for the left figure, you see a change in job destruction rate. You see that construction has a less job destruction rate than manufacturing. So it means that for the sector that has more zombie firms, because like they're not dying out, it means that jobs are not getting destroyed. Well, that may sound like, okay, jobs are there, so maybe that's a good thing. Well, but only after unproductive firms die out, only then the new, more productive firms can enter. So what happened is that for the sectors like construction, there was less of new jobs created compared to manufacturing. So this one does not directly say the substitutions, but yeah, this is about dynamism, that zombie firms are there, then they're not dying out, then it means that those firms with better ideas, more productive, those firms cannot enter, meaning that those zombie firms are dragging down the whole economy in terms of growth rate. So less dynamism is one of the factors that we could see in Japan. And this was fueled partly because of the banks just sustaining, keep giving money to these unproductive firms. And the thing is, this zombification or less dynamism is going on in the US too. So there is a question. What do you think the government will act on those zombie firms? Well, that's a good question. Maybe I can get back to the future part after this presentation, because I have a little bit in a few slides about what is going on right now in the COVID. I'll get back to that question. Okay. So there was a decline in dynamism in Japan during its last decade, and it is also going on in the US, which is supposed to be the entrepreneurship country. And what is going on over here, on the left-hand side, you see a decline in dynamism, which is the decline in job relocation. This is the same graph as before, how many jobs are getting destroyed and being born. And you can see that there is a decline in this dynamism, job churning in the economy. So around like 36% of the jobs were destroying and getting created. But at the same time, at the end of the period, 2012, only like 26% of the jobs are getting destroyed and created. Not only for the jobs, but for the firm entry. Less of the new firms are entering in the market. It means that the new firms are not entering, meaning that new ideas cannot enter. And together with this decline in dynamism, we have seen a slower growth rate in the economy. I'm plotting Korea, Canada, and the world. Let's look at Korea's case, because it has a very high rate of growth, economic growth, in the beginning of 1980s and 1990s, and Asian crisis hit, and there was a decline in the growth rate. And after the financial crisis in 2008, there was an even further decline in the growth rate. It was not only in Korea, Canada, and the world overall has seen a slowdown in economic growth rate. So it has been already going on before COVID. So I am now reaching to the part, going back to our first slide, post-COVID world. What would it look like? Well, the economy is going back, rebounding very strong. This is unemployment in Canada. Well, at the beginning of pandemic in April 2020, almost 15 out of 100 people who were working before pandemic lost their job. But by now, almost only around like 2 to 3 people out of 100 lost or are not working compared to the pre-pandemic. We've been hit by second and third waves stronger than before, but the economy seems to be adapting to this new waves of COVID and rebounding strong. And now the vaccines are coming, so we are expecting stronger growth in the future. But at the same time, there is a worrying sign in terms of dynamism and zombie firms. What happened during the pandemic is that there has been a decline in the business dynamism, but that business dynamism just almost collapsed. What you're seeing here is the change in insolvency, either bankruptcy or firms cannot repay its debt, so it's asking for restructuring its debt. That fraction has changed so much during the pandemic to the extent that April 2020, before it was around 100, but less than 50 firms, for example, are applying for insolvency, meaning that so less firms are now exiting the firm economy. So, and this trend, as you can see, has been going down until right now, February 2021. So less dynamism means that, well, not many firms are exiting, partly due to the stimulus and lower interest rate. But at the same time, it means that there's less dynamism. There's less room for new and more productive firms to enter if the existing firms are not dying out. So beware of zombie firms. That's going to be my last message of this presentation. And thank you very much for tuning in. And I'm ready to answer some of the questions. So let me get back to the questions kind of like one by one. So what do I think the government will act on these zombie firms? Well, one of the things is that we are, and by the way, you know, like this is more in the speculation area, but my thought is we are expecting more increase in interest rates. And zombie firms, according to the existing studies, is living on this low interest rate. So once the interest rates go up, it may, you know, clear some of these zombie firms. But at the same time, so if the interest rate goes up too quickly, then there is also some worries that these firms may die out all of a sudden, which could pose a little bit of instability in the macroeconomy. So that is one of the things that not the government, but the central bank may do, not particularly because of COVID or the zombie firms, but it may happen because the economy is rebounding. And there's a question whether I'm expecting steep inflation after COVID. Well, I think we are already seeing some signs of inflation after COVID, or we're still in the COVID, but the latest figures of inflation is already picking up, and especially for the energy. So if you've been guessing up these days, you might have noticed that the oil price is quite much up, especially compared to in the middle of pandemic. So yeah, prices are already picking up. So that's what I know. And there's a question whether I can explain what is a zombie firm. Well, so there are many ways to measure zombie firms in the data. And one of the ways is how much did they pay for the interest and how much they have profit. If the profit is less than what they should pay for the interest, then this could be one way to measure zombie firms. And there's another question. The growing number of shadow banks implies the possibility of a financial crisis eventually occurring. Then how can you reduce shadow bank? So that's a good question. Well, one thing I actually want to say is shadow banks may pose financial instability, but at the same time, and this is part of my research, is that without shadow banks, these small and more productive firms may not have, ways to borrow money for investment and so on. And these are the firms that have high productivity. Without shadow banks, they may not be able to borrow from anybody. So shadow banks may pose financial instability, but at the same time, they are also helping the growth. So there is some trade-off that is going on in terms of shadow banks. They are, filling in the part that banks are cutting, because banks are cutting their funds to the small and more productive firms. Then shadow banks are filling in. So shadow banks are not necessarily just evil, as their name may suggest. Actually, they might be doing good by promoting growth in the economy too. So maybe we need, and I believe we need some level of shadow bank. It's just that we also need to be aware of their instability. And there is a question, what is the impact of inflation on zombies? That is an excellent question, and maybe this is a speculation area, but if there is inflation, it goes back to the interest rate, because right now there is already a lot of discussion going on about monetary policy, because right now kind of lenient monetary policy, interest rates are super low, but at the same time inflation is picking up, and people are wondering when the central bank will start to roll back a stimulus, meaning that when will central bank increase in interest rate? So that might be linked to the zombie firms, because with the higher interest rate, zombie firms have harder time paying back their interest payments because they're less productive. They don't have much profit. They don't have much cash in their hands. So this may impact the zombie firms to die out. So that would be my kind of speculation. And there's another question. So given that the economy has been recovering, do we think we'll see a boom similarly to how we have after previous recession with the help of shadow banks for smaller, more productive firms? Or do we think factors such as zombie firms will lead to a more steadily increasing economy? That is an excellent part. And for now, I think we have been seeing a steep recovery, almost to the V shape, rather than this like Nike swoosh that we've been seeing for the financial recession. So far, we've been doing well in, going back to this pre-recession level. But so that was, my part of we are not 100% sure whether we're going to go back to its pre-trend, because what I can do best is going back to the history. And the history tells me that after the Great Recession or after the financial crisis, we were not going back all the way to its previous trend. The thing is, after the financial recession, we didn't really go back to this blue line. So if that happens, then we may settle into this new level. But to be honest, this pandemic is once a century thing, and we economists live on data, and we have such spotty data. So I hope that we grow back strong, but I was doing my best to kind of, warn you in terms of we may settle down to a lower level growth because of this zombie firms and so on. And there is a question, if zombie firms access the economy eventually, what are the downsides for zombie firms? Well, zombie firms may not exit eventually. That is the problem. And I was showing this figure. Oops, let me go to this one. Here. So the problem is that zombie firms are hanging around. They're not dying out, just like zombies. You attack them and they're just coming back. So that's the downside of the economy, that only when they exit, then, this credit that has been going, or resources that's been going on to this unproductive firm frees up, and it could go to more productive firms. So the downside for the economy is when zombie firms are not dying out, and that's especially what has been going on since Great Recession, that they're not dying out. They should be dying out, but they're not dying out because of interest rates and banks and so on. And there's another question. In your projections, which sectors are likely to worst hit by our recovery from COVID-19 setbacks? So I've been looking at the sectoral data for Canada, for example. We can see that insurance and finance sectors are almost not hit by COVID. And manufacturing was hit, but by now is almost back to the pre-COVID level. The hardest hit is the entertainment and restaurants and those kind of non-essential services part. Even right now, most of other sectors have recovered a lot, but those sectors still remain 40% lower than the pre-trend, pre-COVID level. So for those sectors, it's taking a long time for COVID to be over. So, based on what has been going on, I'll be mostly, kind of worried about the recovery of those sectors, the non-essential or the entertainment sectors. So there is actually a question, why stock market is so hot? Will it continue? Well, I wish I knew exactly why the stock market is so hot. Some say it's because of the stimulus, because the financial market has been on the lifeline thanks to the easy monetary policy. So some say that it's because of this monetary policy, but that's a hard research question that needs a lot of work to answer, so I can only speculate. Okay, and how about the house price going up and up now? Well, so that's another speculation part that I'm also talking a lot in the dinner. And one thing is that people's demand for house has gone up a lot because, COVID, we're all at home, so we want bigger house. So that's one thing. But another thing is, some people again speculate that it's because of monetary policy with lower interest rate, meaning that it's cheaper to get mortgage. But again, that's my speculation. These are, important but questions that actually need a lot of work, and I would love to do the research about those. And why do banks keep lending to zombies? Are they irrational? Well, they're not irrational. Well, one of the things is that zombie firms may come back, so just like the shipyards has been. And the biggest part is that they are bound for the newer regulation, which zombie firms has more of the physical capital, like machinery, that could be posted as collateral. So that was part of the reason why zombie firms, or the bigger, even though they're not so productive, but if you have a lot of this capital that could be posted as collateral, then you stay with the banks. Okay. So will cryptocurrency impact growth of zombies or vice versa? That's an interesting question. I actually haven't thought much about the link between the crypto and zombie firms. If you have any suggestions for the channel between the two, I would love to learn about it. Okay. And there is a question: would you expect increase in interest level to a level higher than the pre-pandemic level? This is a wild speculation, but maybe, because the inflation rate has stayed low for a long time. But right now, in the recovery, we're seeing quite high inflation rate. So in order to curb the inflation rate, maybe the interest rate will go up. But yeah, again, these are the questions, the deep questions that I need to spend days and weeks and years to study. Okay. Oh yeah, and there's the survey, so please join that one as well. And there's another question. There is a saying that everything that exists has a reason according to the theory of evolution. I agree. What then do you think keeps zombie firms alive despite their inefficiency? Market inefficiency, government, or something else? That is an excellent question, and which I, think I skipped because of time constraint. Well, two things. So, for example, over here, I said that bigger but less productive firms stay with banks. Well, there is a reason why. Because banks now are under tighter constraint, meaning that they are seeking for safer loans. And what is a safer loan? Well, loans that are backed by collateral. These firms, they're big, meaning that they have a lot of capital, like land, buildings, or machinery that they can post as collateral. These smaller firms, they're productive, but they're growing, they're small. They don't have much resources that could be used as collateral. So banks, they're also bound by regulation. So they actually prefer those firms that might be unproductive but have a lot of collateral that makes the loans safer. So that is the kind of ecosystem of financial market that is going on. And for the experience of Japan, the studies show that banks also wanted to keep the firms alive as long as they could, because if these firms go bankrupt, then it means that those banks also need to kind of write up the loans that these firms took. As long as these firms are alive and kind of bet on their survival at some point, then the banks also kind of look healthy. So that is part of the reason why there is zombie firm. There are zombie firms just hanging around, not dying out. And there is another question: would inflation stay high? I wish not. So experts say that inflation, or if you go to Bank of Canada and their projections, then they say the inflation might hike might be temporary and then go down once the economy kind of bounces back and then settles down. So that's how much I would say about the inflation rate projections. And there's another question. Banks tend to feel protected and overly safe because they almost always get bailed out if things go south. That's true. So, there was this too big to fail problem. Banks are too big or too interconnected. And during the financial crisis, Lehman Brothers were let go, and there was a huge shock in the economy, financial economy. And lots of other subsequent banks were bailed out. So that's part of the reason why, or one of the biggest reasons why, there is a new regulation that requires banks to put more of their own capital so that banks, we know that banks may be bailed out, but we want to reduce that probability as much as possible. And so the banks could bail in, meaning that when they're in trouble, they need to use their own money to replenish what they have lost. And that's partly what's going on in this Ortega's, the Bill Huang issue, or the event. Banks did lose a lot of money, but they're not getting bailed out because it's their own problem. They're not going to be bailed out this time. Okay. And yeah, thanks a lot, everybody, for coming to the event.